Okay, guys, today's podcast is about demystifying and getting an insider look on the lending process. We have a special guest, Danny Toe. He has been with us for years. He is a trusted advisor. We have done a lot of deals together. Please, if you liked what we put out there, comment, like, subscribe, and we want to know what you think. Please enjoy this episode, and here we go. We have our first guest today. He's a dear friend. His name is Danny Toe. He's been a lender for a long time. We have a long history together, all the way back to working and selling phones at AT&T, to jumping into the real estate game. We have been through a lot. We've been through millions of dollars in loans, helping clients get through tough situations. First-time home buyer all the way to the repeat investor, moving up in size of a home, moving down. I mean, we've been through it all. One thing that I think makes Danny and myself unique is that we both invest with our own time and money. And through that, we've learned on how to understand the market, how to position it, and really how to strategize and put a plan together, a game plan together for the best results. He works for a company called Origin Point. He recently moved there due to the competitive rates and service because it is very competitive for lenders and agents. Today we're going to talk about the insider look at mortgages. There has been a lot of speculation and talking about a 50-year mortgage, portable mortgage. Where are rates going? Should I leave my 3% rate and get into something else? And instead of us answering it, we've brought in the special guest to be able to talk to us about that. So this is Danny Toe. Welcome to our podcast.
Yeah, I'm excited and it's an honor to be here. I'm happy to share some knowledge and hopefully help you guys out.
Cool, perfect. So if we look at what people are searching for online, the first thing and the most important thing people are searching for is all about interest rates. Right now, the average 30-year mortgage is what usually people are getting into, and they're holding in the low to mid 6% range. And it's really about the monthly payments, right? How is it going to affect my life? Will I be able to afford this? What kind of conversations are you having about especially in the midst of current and future job loss fears, right? What are people talking to you about, and what kind of questions are you getting about rates?
Yeah, with interest rates, so right now conventional loans, you're running about low 6 to mid 6. You have FHA will probably be in the high 5s. In terms of rates and monthly payments, so when you're buying a property, right, we'll run numbers on that. And then we have like buy down options too if you're looking to lower your monthly payment options. But in terms of where rates are heading with job losses and everything like that, with reports, job losses will actually cause rates to go down because the government and the feds, when they raise interest rates to look at inflation, if we can get a bad jobs report, they actually lower interest rates. So the future with interest rate it's most likely going to go down depending on how jobs are being reported.
Okay. What is the difference between, let's say, a 30-year fixed mortgage and a 15-year?
Yeah, so the 30-year mortgage is basically your standard, the industry standard right now. So the monthly payments, for example, let's say we're using a $3,000 mortgage payment. If you go with a 15-year mortgage, it increases your payment by almost $1,500, so almost 50%. So that's the main difference. But you would pay off your loan a lot quicker, so you pay less interest.
Okay. I've gotten questions like, should I get a 30-year and pay more to get a 15-year rate? How does that work? Can you make extra payments on your mortgage, and how does that all work?
Yeah, so you can do a 30-year loan and pay more towards your principal and cut your loan down maybe 5 years or 10 years, depending on how much more principal you pay every month or annually. Some people don't do the 15-year just because the higher monthly payment. So you have to look at affordability too in terms of what you're comfortable with in your payments. are you comfortable with a 30-year fix with $3,000 a month, or paying off your loan quicker with a 15-year at $4,500 a month?
So then the option of having a lower payment, but then being able to pay more is maybe what, do you see that a lot?
Yes, I do see that a lot, just because you have that option too, because if you can't, then you don't have to do it. The 15-year, you're just stuck doing that, making that high payment every single month for 15 years.
Right.
The advantage of the 15-year though is typically rates are about 1% lower. So that's the advantage.
That's a big difference.
But you just don't have the option to say, hey, like 1 month, like I can't afford it. You can't adjust.
Right. If you're looking at how to choose a lender, right? Because that is a search that's coming up quite often online for people. And obviously people are searching on Google, but a lot of searches are going onto AI, Perplexity, ChatGPT, whatever, Gemini, et cetera, et cetera. What should people understand about how to choose a lender?
Yeah, it's a complexity of a few different things, but you kind of hit the nail on the head early on. Rates is what comes up as the biggest thing, right? Because of affordability and how high the payments is, and if you can get a good interest rate, right, that's going to help your payments. So that's the number one thing usually, and that's why I switch over to Origin Point, because we're more competitive. Some other things is communication, right? Are they there to respond to you and be able to craft these plans and situations, maybe on a weekend when you're trying to put in an offer, and being able to close the deal on time so you don't lose your earnest money. But the main thing is rates. But those, I would say, is the three main things: rates, communication, and being able to get it done for the clients, and so they don't lose money.
Yeah, I think what people maybe don't understand is that when you put a contract together, it's not legally required, but you often meaning 100% of the time, put down earnest money to get a deal done. And people may be shopping around for rates, and maybe there is some lenders who can give a different rate or a better rate, but has lack of communication or doesn't close on time. And then I've been in situations where literally $50,000 to $150,000 or more of earnest money have been on risk, right? Because you couldn't close on time. So that's a very good point. Another search that comes up quite often, it has to do with qualification and affordability, right? It is so tough trying to compare rates of 2020, 2021 to rates now. The payments are just insane. And even myself being in the business, as I look at investment properties, as I look at maybe moving up to a bigger home, payments are pretty crazy to understand. So mortgage calculator is a very it's often the most Google term in the category of real estate. How much house can I afford? Another great question. What credit score do I need to buy a house? What is a debt to income ratio? So this all kind of goes into affordability and how people can think about affordability. So what are some of the things that you talk to clients about the topic of affordability? And what are some tips or tricks that you might have to get a better affordable mortgage payment?
Yeah. In terms of affordability around mortgages, we always try to look at the situation, the client situation, in terms of what program they qualify for. Because there's multiple programs out there. One may be better situated for their scenario that can make payments lower. So for example, FHA and conventional. FHA is a government loan, so if you're putting low down payment, you usually can afford more with FHA because they're more lenient in the guidelines and rates are better, depending on how much down payment you put. So in terms of affordability, your lender needs to just look at your scenario and be able to give you these plans and scenarios in terms of how much you can afford, and you kind of compare it. But that's how I will look at it. But putting you on the right program will help with affordability and lower your payments.
So what is the lowest credit score I can have if I have really good income? Because obviously income is needed to qualify. What is the lowest credit score?
Lowest credit score is 580. So 580. You can get an FHA loan at at 580. So a lot of people think they need good credit score to qualify. That's not the case.
And what is the advantage of having a better credit score?
The advantage of having a better credit score really, again, depends on the scenario. A lot of times if you have a better credit score, let's say above 700, you want to go with a conventional loan because you pay less mortgage insurance. But if you have a lower credit score, the mortgage insurance is going to skyrocket because of risk that lender has to take. So then you fall back onto government loans, which is the FHA. And that they don't care about your credit score at all for PMI.
I see. So does mortgage insurance go up because you have a higher interest rate?
No. Interest rate has no effect with PMI. Your
really?
credit score affects the PMI.
I didn't know that.
Yes.
Okay, great. Okay, closing costs. So it's like, yes, there's rates, there's PMI, FHA, conventional, VA, if you're a veteran, right? We'll talk about some of the programs in a second. But how much money do I need to get into a home, right? What are closing costs? Can you help us understand?
Yeah, we have programs out there that will cover your down payment and some closing costs. You can negotiate for sellers to cover closing costs as well. But standard closing costs, rule of thumb, is 2% of your purchase price. Whether it's coming out of your own pocket or down payment assistance to cover it or sellers to cover it, you have to have 2% ready and available for closing costs.
Okay, 2%. And what is that 2%? Is the seller getting all the 2%? Am I paying the government? Like, who's getting the 2% and what's in that 2%?
So within that 2%, you're looking at your lender's underwriting fees. You have your appraisal, title and escrow, which is required with every mortgage transaction. So that there is probably about 1%, half of the fees. Mm-hmm. The remaining is just prepaid items for your property taxes, your homeowner insurance, prepaid interest, depending on when you close. That's the other half. So you need to think 1% is transactional. It's required for the mortgage. The other is just required because you have to prepay these other items of owning a home.
So if I had a suitcase full of cash, that's seasoned, right? You can explain what seasoning is. Can I not pay closing costs?
To answer the question, seasoning is basically verified funds. You can't just have cash deposit today and then use it right away. We have to have at least seasoned for 1 month, so it has to be in your bank account for 1 month, so we don't see that deposit. But yeah, once your funds are seasoned for a month, right, it's been in there for a month, you can use that to pay your closing costs or down payment.
Yeah, we see that quite a bit for gift funds, right? Mom, dad, if you're lucky to have mom and dad or whatever, right? I've seen people pull or borrow from their retirement accounts. That's also a pretty popular one. What is the rule for borrowing against your investment accounts? I think people may be interested in that just because sometimes the markets, move differently in real estate and in the stock market, right? People have 401ks or they have stocks, bonds, or whatever. So how does that work if you want to use that as a down payment?
Yeah, so if you have a 401k, that's actually a very popular option nowadays. Just because when you're borrowing from your own money, you're paying interest to yourself. You're just paying back into your own account down the road. So it doesn't really cost anything compared to if you to use a down payment assistance where they have higher interest rate. So if you do have a 401k, you would need to call them up and they can tell you what the terms are. But that's a very popular option right now just because it doesn't cost as much as if you were to use a down payment assistance program to cover that down payment.
What's the limit on how much you can borrow?
That depends on your company and the 401k itself. I've seen 80%, I've seen 50%. So you would call them to discuss the terms and what they allow you to withdraw from that account.
Oh, so like 50% or 80% of the balance?
Of the balance that you have in there. Yep.
So what's the most you've seen somebody borrow from their retirement account for a down payment?
In terms of a value,
yeah,
I've seen probably 80 to 100 grand.
Okay, that's quite
basically to cover 20% in closing costs.
Got it.
So they don't have to pay PMI, but I've seen up that high, yes.
So then that goes into what do people need to be prepared for down payment? we're going to talk about first-time homebuyer programs that we've taught classes for many years. But traditionally, what do you need to put down?
So you can put down 0% because we have loan programs or down payment assistance programs
Right.
that will allow for 0% down.
Right.
Minimum, if you're looking for your own funds, 3%.
Okay.
Yeah. So it ranges depending on how much cash or if you want to use cash at all from that perspective. But 0 to 20% I've seen with many different clients. But minimum 0%.
What about crypto? Can you sell crypto?
So crypto is big in the last five years,
Sure,
right?
yeah.
So now they do allow crypto as long as again it's the seasoning. We can see that you had this crypto for the past month.
I see.
That you just didn't just inherit it a few days ago or found it or whatnot. Seasoning period again just 1 month.
Because I have a Coinbase account, but I don't think I have statements.
Yeah.
Do you just look at the transaction history?
Yeah,
then?
there will be a transaction history that you can
Okay.
use.
Okay. So if you have a bunch of drug money, you buy crypto with that drug money. No, I'm just kidding. But that is it's a question that we get often only because I've had clients pull money from overseas, from parents, from whatever. So that's a pretty popular question on my end.
Yeah, so and with crypto as well, just to add on, there are some wallets that don't do transaction history or statements or anything,
Yeah,
right? Just because that's why it's crypto, right? Because it's not government government enforced, right? So if you do want to use in a wallet that doesn't generate any statements or transaction, you want to transfer at least a month to an account that does. To be able to use it.
That's good.
Yeah.
Okay. Okay, so another hot topic is first-time homebuyer programs. I will consider us an expert on this topic. We are certified by the state, and you have to be certified to be able to offer those. We'll talk about some homebuyer programs and some other incentives, but what are the most popular first-time homebuyer programs, and what are the pros and cons of each?
Yeah, so the state right now offers something that's called a home advantage program. It covers your down payment plus a little of the closing costs. The pros and cons of that is you don't need to spend any money to buy a property. So that's the pro. So you basically get your foot in the door to purchase, and you don't need any funds outside of the earnest money, which you can get refunded back. The con is the interest rate's higher. So usually it's about 1% higher, so your payments are higher. But if you can afford it, it's a great program because you're spending no capital to purchase a home, and you just refinance it later on.
Okay. If somebody says, man, interest rates are already super high, I don't want to take another 1% hit on my interest rate, I'm just going to save up and save up for that down payment. What kind of advice would you have for them?
Yeah, if you're saving up from your down payment, I would look at the 401k option, right? Because that you don't really, again, you pay yourself back in interest, so if you have that option, you can buy now. The only thing is if you wait to save for a down payment, how long is that going to take you to save 3% or 3.5%, right? It could take you a year, 2 years down the road. What's that going to be like in terms of housing market? Is it going to be more expensive? So cost of waiting, right? If you're waiting to save and not buying until later on, you're losing out on the appreciation of the home itself. So just give or take, depending on your situation scenario.
Yeah, I think what people may not realize is that we still have a low inventory. The last time we checked, we just sent out my business partner Peter just sent out a market update. It's actually in Snohomish and King counties, it's less than 3 months still. I think it's like 2.6 or 7 or 8 months, which is how quickly homes sell essentially. And anything under 4 to 6 months is considered a seller's market still. And home prices are going up. Again, there's been a lot of turbulence, right, in the past couple of years. But year to year, year over year, home prices are still climbing up, albeit slowly. And historically, this is something we always teach in homebuyer class. But historically, if you go back all the way to the Great Depression, Fannie Mae tracks these numbers, and it's an average appreciation of 4.5 to maybe 5%. Average. Could be higher, could be lower, in the last 100 years. I mean, that's World War II, the prosperity in the 70s, a lot of things happening. So I think that is, I guess, an opportunity cost for some people. Okay, so what are some other, so we talked about the Covenant Homebuyer Program. I think this is a crazy program that most people don't know about, but obviously nothing in life is free. So what is the Covenant Homebuyer Program, and what are the pros and cons?
Yeah, so the Covenant Program just launched last year, so fairly new, but it is an insane program. They'll let you borrow or give you 20% as a down payment, so you don't have to pay PMI, and they'll cover you closing costs. So honestly, there's no cons at all, except for being able to qualify for it based on race, and you have to be have a parent or a grandparent that lived in Washington prior to 1968. So those are the two main things. That's the con to get into its qualification. Outside of that, it's all the pros, right? You get 20% down, you get your closing costs covered, so everything covered, and it's a lower interest rate too compared to what the standard rates are. So just getting yourself qualified is the biggest thing.
Okay. So you're saying that the state will give you 20% for free?
So yes and no.
Okay.
So they have this rule within the program: if you make under a certain income, after 3 years, it's free.
Wait, so if you make less than a certain amount of income?
Yeah. So right now it's probably like 90,000 is the county average.
Like household
income.
Okay.
Yeah. If you make less than 90, you can qualify for that program and qualify for that home. Keep it for 3 years. You don't even need to pay them back. If you do make more, the income qualification for that program goes up 150,000. Right? So you can qualify for the program. You don't make more than 90. You just have to pay it back when you refinance or sell.
I see. Okay. So obviously a lot of details there. I mean, talk to your trusted mortgage advisor, real estate advisor. But this is just the tip of the iceberg. I mean, we'll cover some more programs, but most people just understand the 30-year, maybe the 15-year. The other thing, there are some other incentives that, in this landscape and in this economy that we have implemented also as a team. We have different things like the tech package, right? We have, for people who work in tech, obviously they're hurting right now because of all the job losses. We have a tech package to help them out. We also have a moving package for certain types of clients that might qualify. Sometimes we will partner up on a deal and offer them an incentive for working with us. And the advantage for us, besides being able to help somebody out, is the fact that we know how each other's processes work. The story that I always tell people about Danny is that his communication's a little bit too good. I remember he was in Vegas having a birthday thing, or it was like 11 p.m. I remember it was like 10 or 11 p.m. and I randomly sent a text. It's like, hey Danny, can I get a pre-approval letter? And I'm like, yeah, it's 11 p.m. I know he's in Vegas. I'll get it the next morning. And then before midnight, I had a pre-approval,
And it's important, I'll get it done.
And again, that's not something I would want Danny to do all the time, but communication, in this market, everything moves so quickly that time really is money and opportunity. Another thing that we are doing is the lifetime home support, where we have a lot of vendors that work with us, like you, or Nick, are from Castaneda Carpentry, or my friend Cody, who is opening. He's a plumber, and he'll be doing kind of a partnership with us, so we have access to those vendors because oftentimes people need good people to trust, and we rent out for free, like party supplies. If you have kids, or if you just want to throw a nice party at your house, we have like cotton candy maker, we have shave ice makers, popcorn poppers, and we also have home improvement tools that we rent out for free as well. So I think it depends on who you trust. I mean, please see your trusted advisors and just see, hey, what can they do for me at this time? Going into a little bit, so let's just say what we covered is loans 101, okay? That's what most people will qualify for, what most people will need. But what about beyond the traditional 30-year fixed, the 15-year fixed? Can you tell me a little bit more about adjustable rate mortgages, buying down points to be able to get a lower rate? Can you touch on some of those things?
Yeah, so we talked about 30-year fixed rates. So another loan program long term is an adjustable mortgage. So we brought up like lowering your payments. So that's what an adjustable rate, which we call ARM. So that's what an ARM program allows for. So what it is, it gives you a low rate in the beginning, right? So you have a lower payment, and then it'll adjust down the road, whether it's 5 years or 7 years. You just want to refinance down the road to a 30-year fixed. But that would help with affordability and lowering your mortgage payment is a ARM program.
So what type of people and in what situations should people consider an ARM?
I think that if you believe interest rates are going to drop, then you should consider an ARM because it will help you with payments, and then you're just going to refinance when the rates go down. If you don't think mortgage interest rates are going to drop, right, I wouldn't advise on the ARM because later on, that ARM is going to go from 6% to 7 or 8% if interest rates are higher because it adjusts.
Why do lenders even offer ARMs?
We offer ARMs just because it's an option for borrowers to qualify for more if you need to, right? Because that's going to lower your payment initially. So on a 30-year fix, let's say a payment is $3,500, an ARM might bring it down to $3,300 or $3,200, right? So it gives you more affordability. So it's just more options, being able to have that for clients.
Okay, so let's get into some of the more controversial ones. And some of these that we'll talk about aren't even available, but it's all over the news, right? So we want to address it. Can you talk to us about 50-year mortgages and portable mortgages and kind of the pros and cons of what you think that could look like?
Yeah, so the 50-year mortgage was just recently brought up by Trump. The reason why is because he wants to increase affordability, right? So what a 50-year mortgage does is it lowers your payments. So let's say, for example, on a $400,000 loan, right, you probably save, compared to a 30-year fix, you probably save about $300 a month. So that's going to help you afford more, right? So that's the pro, right? So affordability. With a lower payment, you can buy more house. The only thing is compared to a 30-year, you're paying about 70% more over the lifetime. So let's say a $400,000 loan, you're probably going to pay an additional 70% of interest through the loan. So is saving $300 a month worth it if you're going to have to pay 80% more in interest?
That's a lot of interest.
Yeah.
70 to 80% more?
Yeah.
Wow.
Yeah.
Okay.
And again, all speculation, and that's assuming that rates stay the same, right? Because we talked about 15-year and 30-year earlier, right? You get a lower rate on a 15-year program because lenders believe it's less risk. For them, it's less risk because you're paying your loan off earlier. Now we're adding 20 more years to the loan term. Are we going to get that same 6% rate, or is it going to be 7%? So that's the other thing that comes into play.
So if there's a 50-year mortgage, but you have to pay a higher interest, I mean, what's the point?
Exactly.
Yeah. So why do you think Trump is even thinking about the 50-year mortgage?
It's just he doesn't think about the lending aspect of it, because all these numbers and all these speculations saying, hey, 30-year fix, 50-year fix, if we're running at the same 6.5%, yeah, it does make sense. But these lenders, they're taking more risks. So if it gets approved, right, they're going to change their guidelines and they're probably going to increase interest rates. So I don't think that came up when he mentioned it.
Okay. You think Trump is trying to just put it out there for another political reason?
Could be.
What do you think?
It could be. That's what I think. I just think from being an expert in the mortgage industry, I just don't think that's going to come to fruition. The reason why it says Origin Point, another reason why our team went over to Origin Point is we have 40-year mortgages. I was like, okay, hey, this option, right? This might help clients. But we actually don't use it a lot because, again, rates are higher. So these clients where we present these 40-year options to, it doesn't make sense because they'll save them 100 compared to like a 30, 40, 50, right?
Right.
On a 40, it'll probably save them $150 a month. But a higher rate, does that make sense? Down the road, you're paying more interest. So there's a lot of cons compared to pros when you go with a higher term.
Why is it that? Why? Because if I'm a consumer, I'm thinking, man, I'm paying 10 to 20 years more on my mortgage, and it's only saving me a couple $100 a month. Why is that? Why is the savings? This should be like $1,000 in my mind, or if I'm a consumer.
Yeah, because so on mortgages, it's compound interest. So in the beginning of your loan term, you're paying a lot more interest, right? So if you're extending your loan term, you don't get to pay more towards principal towards the end. Now 10 or 20 years further on. So that's how the interest gets added on. Because now instead of paying more principal towards the end of your term, you're tacking on like 10, 20 more years, so you're paying more interest now. Because there's no room for you to pay more principal and cover that interest.
So if I pay more, whether it's through a 50-year or a higher interest rate, am I paying more in principal? Or is it just interest?
You're paying, if you're extending your term, so there's two things. So first is rates, right? If you have a high interest rate, you're paying more interest than principal. If you have a longer term, same exact thing. You're paying more interest than principal because of the longer loan term.
Right. Yeah, I just can't see a reason why people would do that. Okay, portable mortgages. Can you talk to us about what that could look like and why are they even considering that?
Yeah. Again, all speculation. Portable mortgage, I think makes more sense personally from a consumer standpoint, but from a lender standpoint, I don't see it, and I'll give you the reason why. So the reason for portable mortgages is basically for inventory. Right now, a lot of home buyers are sitting on 2%, 3% rate. They don't want to sell. They don't want to relocate. And so there's no inventory, right? So Trump brought up, hey, what about portable mortgages where if you can carry that interest rate to a new property, would that make more sense? And I can see that making sense. The only thing now is two things. One, from a lender standpoint, why would they do it? There's no benefit for them. They're taking more risks transferring these mortgages, right? So are they going to charge a premium to allow you to do that, right? So why would they do it if they don't make money out of it?
So when you say premium, what does that mean? Is it going to be a higher interest rate, or is there a fee, more higher closing costs?
Yeah, so it wouldn't be a high interest rate because portables allows you to port that mortgage, right? So, or it could be, but from my standpoint, I think a premium as in more closing costs, a fee to be able to do it.
I see.
And the second thing is, if you're upgrading, you're buying a more expensive property, right? You're only carrying that same loan amount over. How do you cover the difference? Are you going to have enough cash to cover that difference? If not, then you have to get a second mortgage to cover the difference, and that second mortgage is going to be on a higher interest rate.
What are some second mortgage options for people?
So the second mortgage, like they're HELOCs, and you pull out an equity line of credit. So those are options, but rates are probably going to be in the 7 to 10% depending on scenarios.
Right. Yeah, I've personally gotten a HELOC, which is a home equity line of credit, and it can be useful as long as you don't start using it like a bank account, right? Which,
yeah.
I mean, I have partially, and the way a HELOC works is you can choose to pay interest only, which lowers your payment, but you're not paying anything toward principal. Mm-hmm. Or you can choose to lock it in and have it as an actual second mortgage. But in all scenarios, and I've learned this from you and from other lenders and from myself, is you still have to be able to make the income to qualify for those mortgages. So at the end of the day, it kind of goes back to the really boring stuff, which is, are you in control of your finances? Are you getting paid enough at your job? Do you need to get a different job? Do you have to, figure out a way to get more? Do you dig into your, savings or your 401k or your parents or whatever it might be? Because it's not just in a vacuum, it's all related. So these questions, again, are what people are asking, and, we have definitely gotten those questions as well. Okay, so what about, okay, so I'll cover just real quick. There are also hard money and construction loans, and this is a space that I sometimes live in because, again, we are investors. Have you done hard money before?
I haven't.
Okay.
I have clients who have, or family members who have, so, and we've talked about hard money previously, so I have experience, just I haven't done it personally, because usually I have private investors that I discuss with.
I see. So basically, again, maybe a few people out of 100 will even know about this or even use it, but there is a way to gain very, very quick cash to invest in a property, to fix up a property, to maybe do something to improve the property and then refinance into a regular loan. There's also construction loans. Again, we won't go too much into detail about that, but they are very risky, high risk, high reward loans. And if you want more, information about that, you should consult your advisors, your real estate professional, or your lender. But I think this just illustrates that there's so many types of things that people don't really understand. And honestly, even when we teach first-time homebuyer classes, like, I'll raise my hand and actually ask you questions. And I've done that.
Yeah.
And it's not because I'm, it's not scripted. Like, I actually have a question, so.
I think the biggest thing is just having options. So hard money is just another options out of like all these other options that
Right.
kind of allow you to invest or buy a home.
Right. Okay, so inventory and timing. So we're in a really weird spot where, I have a friend who have multiple friends who've been looking for months because there isn't the right home to be available. And why is that? Well, it's because a lot of these properties are locked in the sense that, and this is why the portable mortgages probably came up, is that a lot of sellers, including myself, and I know at least for some of your properties, you also, are locked into these really crazy 2 to 3.5% mortgages that will maybe never ever come back. And obviously the government did that to spur growth during the pandemic era. But why would I go out of my 3%, $4,000 mortgage to get into a double the mortgage payment to step up into a different home? So a lot of those sellers are just sitting, and because they have a lot of equity and their payments are so low, and with the rent prices going up and up and up. I mean, I remember I used to rent a place called the Barbie. Like, it was literally called the Barbie. When me and it was in Ravenna, UW district. It was me and my then girlfriend, who's now my wife. It was a 1-bedroom, 600 square foot apartment. We paid $800. That doesn't exist anymore. Even for a 1-bedroom in Seattle, I mean, you're probably thinking $1,500 to like $1,900 a month in rent, right? Literally double. So what's happening is people are searching for very localized or neighborhood-specific searches. A couple of really hot topic searches are homes for sale near me, new construction homes for sale, because builders are giving away a lot of incentives also. And there are caveats to everything, but they are, buying down interest rates like we just talked about. Maybe there's like a, like one of our clients just got a $50,000 credit, which is crazy. But that sometimes has its own caveats and own strings attached to it, which, If you have any questions, please reach out to us. There's also foreclosed homes being searched, fixer-uppers. So what is happening is people are looking for, where can I find the inventory? And right now people, some of the things that we're doing for people or clients, and for us is, we're going off market a lot of the times. I mean, you've gotten an off market home, I've gotten multiple. You have to get creative and look for locked inventory, is what we would call it. Is inventory that's out there that somebody might be willing to let go of, but they're not necessarily on the market yet. It could be a neighbor. It could be friends that know other people. It could be literally driving past the home and there's like contractors working on the home. You can go knock on the door. You have to get creative, and that's some of the things that we do is we network with off-market sellers to try and unlock that locked inventory. And really, we also get a lot of questions about market timing and strategy. Is it a good time still to buy a house? When is the best time to sell? And what is my home worth? We're doing equity reviews for a lot of people. We're getting a lot of questions about, should I even be in the market right now? What are your thoughts on when people ask you, is it a good time to buy?
Yeah, it's a tough time to time the market, one with house prices, mainly also interest rate, because it's higher and it causes your payments to go up compared to COVID years. So at the end of the day, for me, I always advise, hey, as long as the payment makes sense for you and you can afford that month over month, right, then it makes sense. Because you can't really time the market and wait for a lower interest rate and things like that. The reason why is because if you can afford it right now and it makes sense, right, you can buy now before rates go down. Because when rates go down, the market is going to be crazy competitive, where we're going back to like bidding 50 to sometimes 200,000 over on these houses, right? If you bought now, you're avoiding all that, and you can refinance down the road to get that low interest rate, right? So avoiding that, but at the end of the day, it just comes down to your mortgage payment. As long as you're comfortable with that and can handle that for a year or two until rates go down, then yeah, I'd say buy so you can avoid the competitive market.
So what if I want to wait for a really low interest rate? And is that going to be next year? Is that going to be 2027? What are your thoughts on that?
That's the thing, we don't know. Like it's so hard to time everything. The projection is rates are going to come down as inflation goes down. So year over year, we're down. I believe last year we're probably higher 7%. Right now we're in the mids. Some programs are low 6. So it's getting there. It's just how quickly do we get there? It really depends on the economy and the inflation, if that's getting better. But it's going to go down, and I think it's going to cause a crazy competitive market later on, right, once it does go down, because everyone's waiting.
Right. How many people do you have approved and ready to go?
I have a good amount. It's just there's no inventory.
Right.
That's the biggest thing. Outside affordability and rates, there's no inventory as well. So I think that's why these 50-year mortgages came up, the speculation, right, and these portable mortgages, because one, affordability, and two, inventory.
So, I mean, I know you have a lot of people that trust you and just kind of come to you in your community. If someone were to say, hey, I've seen a lot of job loss news on job loss reports on the news, which is obviously true. I mean, Amazon, tens of thousands of people, Microsoft is a recent pain point. Even healthcare providers are actually being let go, which is crazy, right? Because my wife is in the healthcare field. Are you seeing that though, as a whole? Are you seeing a lot of people? So if you have, let's say, 50 people approved or ready to go, I mean, I'm sure you're working with more than that. But if you have 50 or 100 people approved, how many of them are dropping out of the game because they have lost their jobs?
So the thing is, none. So
oh, wow.
Right now. So let's say I have all these approvals, right? But none of them drop out because I believe these clients they know or don't plan their job to be to be lost or to be laid off, right? I think the people who are uncertain are not even getting pre-approved because there's no stability. So if there's no stability, they shouldn't they're doing it right. They shouldn't be getting pre-approved, right? Because you can't afford your mortgage if you have no stability or you know that you're going to get laid off. So all my pre-approval has been pretty stable employers employing for these employees, right? So I haven't had that issue. I don't recommend this, but I have actually talked to people that do bring it up. It's like, okay, what if the 1% chance I do get laid off or unemployed because of how the market is? So there's something called forbearance as well that will help you out. Not a lot of people know of because we're kind of past that COVID stage.
Yeah.
But it was available before COVID too, but COVID brought it up because everyone got laid off or they're being furloughed, so forbearance came up. But forbearance is always there. So if you happen to be that 1% and lost your job, you can request a forbearance for 3 months or 6 months, depending on how much you're laid off. So you don't have to pay a mortgage. So that 1% of being laid off shouldn't hold you back from buying, because if you're thinking, oh, I can't afford a mortgage down the road if you get laid off, that is an option. I don't wish upon you losing your job, but it is a backup option if that's there.
And something that, since you went there, I'll go there too. Something that we know from being in the foreclosure short sale space is that, being a homeowner is actually way more safe than being a renter. I'm a landlord. Like, me and Peter are landlords. I know you are too. And we can't, if we talked about your stories, we'd have another 2 hours of podcast. If you get into a home, you bought a home and you lost your job, maybe even the forbearance period is out. Maybe you're jobless for a whole year. Well, as soon as you stop making payments, you will get what's called a notice of default. Hey, you got to pay your mortgage, 30 days late, 60, 90, 120, and then the foreclosure process starts. Okay, so without mentioning any names, I'll give you a very specific example. We have a friend who got a notice of default letter in February of last year. We had the auction sale, this is selling your house at an auction type sale. Auction.com. You can go online and find deals. But anyway, February to November, you could have still been in that house. We actually just got that delayed for another 90, let's just be safe, 90 days, with the help of a lawyer and some people that we know. That's a long time. That's a whole year. Not saying you should do that, but if you do lose your job, something bad happens, and you're going to lose your house, you have a year of living in there for free, right? Again, you could say that's morally wrong, etc., etc. But when it comes to your family being on the street, compare that to being a renter. Technically, as soon as you don't pay, you can give a 3-day pay or vacate notice, and then you could potentially be kicked out. Now, obviously, that's not true for every case, but it is actually most of the time a safer thing to be in your own home if something goes awry or wrong. And again, these are things that we just kind of understand. So just to kind of wrap this up, let's quickly talk about refinancing. The desire to refinance is strong. At least we get talked to all the time, and I'm sure. Well, first of all, what's the conversation like around refinancing, and how many people do it, and what's the pros and cons of refinancing?
Yeah. So with refinances, pros and cons is basically, with refis, you have to look at the cost savings, right? So the break-even period. So the refinance generally costs about $5,000. If you're paying that amount, how much are you saving and what's your break-even point? So for example, let's say we use a $5,000 amount. Let's say you save $500 a month, right? In 10 months, you have already paid off that cost. So that makes sense. Anything under a year, sometimes even 2, makes sense to refi. Even if you're waiting or thinking rates might drop, like you just don't know, right, with uncertainty. But the pros is you get monthly savings, whether it's a couple hundred to 500, depending on your loan amount. The cons is just a fee, right? But as long as you break even or you get enough savings per month to cover that fee over a certain period, right? Depending on what you want. If you want it to be 6 months, if you want it to be a year, what makes sense to that specific scenario, then I would do it.
What about people who already have a low, maybe they have a lot of equity, but they also have a low interest rate, and they say, I really want to get some cash out because of whatever reason. Could be health, could be home improvement, could be whatever, right? What does that conversation look like?
Yeah, so if you're refinancing or trying to get cash out with a low rate, you wouldn't refinance, right? Because when you refinance, you basically get rid of that mortgage and the low interest rate, and you don't want to do that. If you're looking to get cash out, what we do is a HELOC. It's an equity line of credit, right? So you keep your interest rate and you just get a line of credit for the amount that you want it to be, right? That allows you to keep your low interest rate. So you wouldn't refinance if you're looking to get cash out.
Okay. Yeah, I think we covered a lot. Obviously, this is the tip of the iceberg. There's a lot of caveats and different things that people should consider if they are thinking about buying, selling, refinancing, construction projects, life, things that are happening that you might need cash for. But as a real estate professional and as a friend, we always say, look, you got to understand your income, your assets, do your budget, understand what room you have. If you're going to save for a down payment versus getting a down payment assistance program, weigh those things out. I mean, the numbers will essentially tell you the truth. It's super boring, but you need to know your budgeting and your numbers.
Yeah, from a lending perspective, it's not a one-size-fits-all kind of a loan program or whatnot. You want to talk to your trusted lender or trusted advisor, right? So they can present options that meet your profile, that makes sense for you based on, are you trying to get savings now, or are you trying to save down payment, right? There's different scenarios. Are you trying to save cash now, or if it's just a monthly payment, what your comfortability is, right? There's different programs too. So that's why there's so many options out there, and it's not one size fits all. So talk to your loan officer or trusted advisor to be able to guide you on the right path that makes sense for your scenario.
Yeah, well said. So in closing, just the overall situation right now in the market is, prices are still steadily increasing year over year, like I mentioned before. We have less than 3 months of inventory, which means that it is still a seller's market. And I'm sure in other parts of the country that might be different, but for us, it's always been like that. Now that's much, much higher inventory than 1 month to 2 weeks, which we had during the pandemic era. I mean, like a monkey could list a home and just sell it, just like that. It is not that way anymore. We are actually able to get discounts. We are actually able to have seller concessions to help pay for closing costs or rate buy downs. There's a lot more flexibility. God knows builders are giving away things to get things off their inventory. And you have to understand that, okay, we don't live in a vacuum. If the rates go down, which we are projected to in the spring, according to our research and belief, when rates tick down, people will start buying again. It is just a psychological fact. And I know this because I can literally track increased showings on my listings as soon as the rates drop. And it doesn't have to be 1%, it could be a quarter point. And people are like showing homes and getting out there because it's a very psychological, right? So please talk to your professional, think about your plan. If you truly want to wait, that's totally fine, but understand that it always comes with other risks of being flooded and being in that. I mean, if you have 50 people ready to go, how many other top lenders do, right? And multiply that by the amount of money that's being able to be poured. And I think it's an interesting thing to think about and consider. we are also, as a real estate team, we're also doing as much as we can. We're doing incentive packages. We're even doing a job loss program that we just released where if you have lost your job, we are actually selling your home for free. And again, that should never be your first option because there's so many other options to be able to, be in a more stable position. But I think this is the time where people are trying to incentivize people to stay in the game and to be able to just hold on until things get better. And I think that's pretty much it. So thank you, Danny, for being our first guest.
Thank you for having me. It's an honor.
And hopefully you'll come back and share more stories. I definitely want to hear your tenant story next time. But yeah, thank you guys very much, and we'll see you soon.